Hi, good morning, good evening, or good morning, good afternoon, or good evening. We're now going to start our second module. This deals with the individual residence rules in Code Section 7701B. I have posted on the classes on the website. I have posted slides that you can look through relating to this lecture, relating to the second module. I've also posted assignments for the second module, including a written problem. Unless you hear otherwise from me, this will be due by the fourth week of the term. Again, please feel free to email me with any questions or concerns. Let's get started. So again, we're talking about the individual residence rules contained in section 7701B. Professor Loken covers this in paragraph 65.2 in your text. Professor Loken notes in paragraph 65.2.1, because resident aliens are taxed on worldwide income, while non-resident aliens are taxed only on income that originates in the United States, it is frequently necessary to distinguish between these two categories of taxpayers. Neither status is uniformly preferable to the other. Resident status has the disadvantage of requiring the alien to report worldwide income, but non-resident aliens cannot take certain deductions that are allowed to citizens and resident aliens. Let me observe at the outset that a U.S. citizen or U.S. resident generally pays U.S. income tax on the individual's worldwide income, regardless of whether the U.S. citizen, of where the U.S. citizen, and in the case of a green card holder, uh, or substantial presence resident, which I'll talk about, resides. For example, a U.S. citizen or green card holder spending the entire year 2021 in Paris, France, is still generally subject to U.S. tax from all sources of income. There's an exception for limited amounts of earned income pursuant to section 911, which will be actually the next topic we cover after the residence rules. So again, U.S. citizens and U.S. residents are taxed generally on worldwide income. There's no distinction made between citizens and residents in terms of taxation. Treasury Regulation 1.1-1B provides that in general, all citizens of the United States, wherever resident and all resident alien individuals, are liable to income taxes imposed by the code, meaning the Internal Revenue Code, whether the income is received from services within or without the United States. The same would be true of other types of income. Along with whatever protection and benefits it confers, U.S. citizenship and or residency brings worldwide taxation in general as its price. Just pause for a second. As I said, one notable exception from worldwide taxation for individual citizens and residents is the exclusion from income of certain earned income, foreign sourced earned income, and certain housing under section 911 for those living and working overseas. The Internal Revenue Code does not define the term citizen of the United States. Treasury Regulation 1.1-1C, however, provides that every person born or naturalized in the United States and subject to its jurisdiction is a citizen. Citizenship for U.S. tax purposes, thus congruent, i.e. in harmony with citizenship under the nationality laws. Let's turn to section 7701B, which was enacted in 1984 and defines the terms resident alien and non-resident alien. The most important features of section 7701B is that it classifies as resident aliens two key categories of individuals. First, under the lawful permanent residence test, which is often referred to as the green card test, an immigration status, an individual who holds a green card for immigration purposes is classified as a resident alien whether he or she lives in the United States or abroad. And see Internal Revenue Code section 7701 B1 cap A, little I in parenthetical, and 7701 B in little b in parenthetical, C in parenthetical. The second category is that of the substantial presence test. Under this test, an alien class is classified as a resident alien if he or she spends 183 days or more in the United States during the taxable year, or is determined under a special look-back formula, which we will discuss in a few minutes. And again, the substantial presence test is defined in section 7701B in parenthetical, 1 in parenthetical, cap A in parenthetical, 2 little i's in parenthetical, and it's described in section 7701, little b in parenthetical and 3 in parenthetical. However, the substantial presence test contains special rules and exceptions. There's a third category of resident alien referred to as the first year election. It's listed in 7701, little b in parenthetical, 1 in parenthetical, cap A in parenthetical, 3 little i's in parenthetical, and explained in 7701, little b in parenthetical, 4 in parenthetical. And we'll come back to this later. By the way, section 7701, little b in parenthetical, 1 in parenthetical, cap B in parenthetical, defines the term non-resident alien as an individual is a non-resident alien if such individual is neither a citizen of the United States nor a resident of the United States within the meaning of subparagraph A. Subparagraph A defined the term resident alien. Let's go back to your text, and I'm in paragraph 65.2.1 and read the rest of the first paragraph, starting with the third sentence. Resident versus non-resident status is also important for many ancillary issues. For example, a non-resident alien spouse can join in a joint return only in limited circumstances described in code section 6013 little g in parenthetical and 6013 h in parenthetical, and under 152 section 152 little b in parenthetical, 3 in parenthetical, some non-resident aliens cannot qualify as dependents. Professor Loken goes on to note in paragraph 65.2.1, first paragraph, last sentence, whether one set of disadvantages outweighs the other depends on the facts of each case and may vary from year to year with respect to any individual. To recap, pursuant to section 7701B, an individual who is not a citizen of the United States is treated as a resident for all federal income tax purposes if he is either a lawful permanent resident at some time during the taxable year, which is referred to as the green card test, or meets a substantial presence test for the year. As Professor Loken notes in section 65, paragraph 65.2.4, first sentence that I mentioned, and as I mentioned earlier, an alien can sometimes elect to be treated as a resident for a portion of the year that immediately precedes the year in which the substantial presence test is first met. This is referred to as the first year election, and again, I'll discuss that later. Let's now focus on this lawful permanent residence test, also known as the green card test. And as I said, it is discussed in section 7701, little b in parenthetical, 6 in parenthetical. And so let's read that section. Please hold on for a second. The 7701B6 says, for purposes of the subsection, an individual is a lawful permanent resident of the United States at any time if A, such individual has a status of having been lawfully accorded the privilege of residing permanently in the United States as an immigrant in accordance with the immigration laws, and B, Such status has not been revoked and has not been administratively or judicially determined to have been abandoned. An individual shall cease to be treated as a lawful permanent resident of the United States if such individual commences to be treated as a resident of a foreign country under the provisions of a tax treaty between the United States and the foreign country, and does not waive the benefits of such treaty applicable to residents of the foreign country, and notifies the Secretary, meaning the Secretary of the Treasury, of the commencement of such treatment. The key, I think, is that in general, a lawful permanent resident is an individual who has been lawfully granted the privilege of residing in the United States as an immigrant in accordance with U.S. immigration laws, and such status has not been revoked and has not been administratively or judicially determined to have been abandoned. In other words, in general, a foreign national holding an immigration green card is a lawful permanent residence. Revocation, sometimes referred to as rescission, occurs when a final administrative or judicial order of exclusion or deportation is issued with regard to an individual. For this purpose, an order that is no longer subject to appeal to a higher court of competent jurisdiction is a final judicial order. And the site for that, and again, I'm not going to test you on reg sites. I do expect you to know Internal Revenue Code sections, but not reg sites, is regulation section 301.7701, little b in parenthetical, -1 in parenthetical, little b in parenthetical, 2 in parenthetical, and 3 in parenthetical. Let's turn to your text, paragraph 65, 2.2, which says a lawful permanent resident of the United States is considered a U.S. resident under 7701B. An individual becomes a lawful permanent resident of the United States by being lawfully accorded the privilege of residing permanently in the United States as an immigrant in accordance with the immigration laws. An alien holding a green card, in other words, is a resident. Professor Loken continues in 65, 2.2, second paragraph. Once permanent residence is obtained, individual generally continues to be a lawful permanent resident until the status is either revoked or administratively or judicially determined to have been abandoned. In the absence of such a revocation or determination, a green card holder is a resident, even if the person resides in a foreign country and comes to the United States so infrequently that on scrutiny, he or she is no longer legally entitled to permanent resident status. Congress required a revocation or formal determination of abandonment to terminate residence in order to prevent aliens from attempting to obtain an apparent right to enter or remain in the United States while attempting to avoid the tax responsibilities that accompanies that right. And so the whole idea basically is to pretty much treat immigration status and tax status congruently. That is the same. He goes on to write, however, a green card holder ceases being a lawful permanent resident for U.S. tax purposes when he or she commences to be treated as a resident of a foreign country under the provisions of a tax treaty between the United States and the foreign country, and notifies the IRS of the commencement of such treatment without waiving the benefits of such treaty applicable to residents of the foreign country. Under most U.S. income tax treaties, green card holder is generally a U.S. resident for treaty purposes. But if he or she is also a tax resident of the other country, his or her treaty residence is determined by a tiebreaker rule, really a series of tiebreaker rules, that, for example, puts residence exclusively in the other country if that person has a permanent home in the other country, but not the United States. And we're going to come back to tiebreaker rules at the end of the module. But let me just give you the example that Professor Loken provides. Again, I'm in that 65 2.2. Assume Glenda, a national of country X, comes to the United States and obtains a U.S. green card. But after living in the United States for several years, she returns to her home country, establishes her permanent home there, and gives up all ongoing ties to the United States other than her US green card, which she retains and occasionally uses when visiting the United States. Glenda is a US resident so long as she retains her green card, unless the United States signs an income tax treaty with country X, and Glenda becomes a resident of country X under the treaty. If she becomes a treaty resident of a country X, her US tax residence ends as her country X residence begins under the treaty. If she notifies the IRS of her status under the treaty and does not waive the benefits of the treaty. Let me pause for a second. If this were a live class, I'd be asking you whether you had any questions. Obviously, the way to communicate with me in this asynchronous class is to shoot me an email. And if I think that your question is germane to many students, I may I may answer it to the entire class. I want to briefly tell you about a tax court decision called Topsnick v. Commissioner. The site is 143 Tax Court 240, the 2014 decision. It's cited in footnote 13 in paragraph 65.2.2 in your text. The petitioner in that case, one Gerd Topsnick, contended that he informally abandoned his lawful permanent status before the years at issue, which were tax years 2004 to 2009, and was therefore exempt from US taxation under the Germany-US tax treaty on gain from his installment sale of stock in a California company. I'm not sure if you learned about installment sales in your other course, but with the installment sale, what takes place is you're not taxed in the year of sale. You're taxed when you receive payment. So, for example, if one sells property for 100 and has a basis in the property of 0 and gets $10 in year 1, 2, 3, 4, etc. In each year, you'll pick up 10. You won't pick up the entire 100 of gain in the opening year. So Topsnick had sold his US residence in 2002. He allegedly moved back to Germany then, and then he claimed made only infrequent trips to the United States. It was undisputed that he did not formally abandon his lawful permanent resident status until 2010. In that year, he surrendered his green card. So he didn't lawfully end his residence absent treaty until 2010. The court, in holding against Topsnick and holding for the IRS, emphasized under section 7701, little b in parenthetical, 6 in parenthetical, cap b in parenthetical, and the regulations thereunder, lawful permanent status continues until it's revoked or judicially administratively determined to have been abandoned. Therefore, Topsnick remained a lawful permanent resident during the years in issue, according to the court. The court further found that Topsnick could not avail himself of a treaty exemption because he wasn't taxable in Germany. He wasn't a German resident in those years. The court noted he didn't file German income taxes, which were required of a German resident for the years at issue. I think that the court got it right. Let me now address the second major test of being a resident of the United States. This is the substantial presence test, and it's covered in your book in paragraph 65.2.3. Let's read 65.2.3, first paragraph. Under the substantial presence test, an alien individual who is present in the United States for at least 183 days during the taxable year is a resident for tax purposes. An alien present in the country for fewer than 183 days during the current year is a resident if he or she is present for at least 31 days during the current year, spends substantial portions of her time in the country during the 3-year period ending with the taxable year, and has a closer connection to the United States than to any foreign country. Exceptions are provided, however, for teachers, students, commuters from Canada and Mexico, and a few others. These rules are described in more detail later in this section. That first paragraph in 65.23 is somewhat of a generalization, and I'll go through and explain it in detail, for the next few minutes. Professor Eisenberg explained that at close range, the substantial presence test really has two forms. One is a strong form and one is a weak form. Let me be clear, the terms strong and weak are not in the Internal Revenue Code. It's just his way of characterizing really two separate tests that I'll explain. Under the strong form of the test, U.S. residence results from the actual physical presence of an individual in the United States for 183 days or more during a calendar year, unless certain specific exemptions or exceptions apply, like you're not counting days because you're a student or a teacher or a diplomat, and I'll come back to that. The strong form of the substantial presence test, i.e., being in the United States for at least 183 days in the current year, is really a sort of a straitjacket provision under which United States residence follows automatically from physical presence of 183 days or more. Let me again add that, as we'll see, certain days don't count if you're teaching, if you're functioning as a teacher or a student. You meet certain other requirements, or a diplomat. So we'll go through those exceptions later. So under many exceptions, days don't count. But let's assume that days do count. If you're here in the United States for 183 days or more during the current year, you are a resident under the substantial residence test. A foreign individual who crosses the 183-day threshold of physical presence is generally treated as a U.S. resident for the entire calendar year. As we'll discuss, however, in the first and last years of U.S. residence, the status of U.S. residents generally may extend only so long as physical presence in the U.S. And again, near the end, closer to the end of this lecture, we'll talk about first and last years of residence. Professor Eisenberg notes that one may flunk the 183-day test by accident and be subject to U.S. taxation. So, for example, suppose somebody had planned to leave after 182 days, but he extended, his kids wanted him to stay in Disney World one more day. And as a result of that, he accidentally spent 183 days here. Well, he becomes a U.S. resident. Why was there a need for a weak substantial presence test? Professor Eisenberg explains that if United States residents turned on nothing more than physical presence for 183 days in any given year, it would be relatively easy to work around the number. By spending 180 days in the United States for several years in a row, for example, a foreign national could maintain a permanent connection with the United States without ever becoming a U.S. resident if the weak substantial presence test did not exist. The weak substantial presence test addresses the following type fact pattern. This type fact pattern. The weak form of the substantial presence test takes into account not only time spent in the United States during the calendar year, but also time spent in the United States in the 2 preceding calendar years, which after a mathematical adjustment are added to days in the calendar year in measuring substantial presence. The effect of this is to include periods of protracted but less intense a connection with the United States as periods of US residence. So let's read section 7701, B3A and B. I'll read that now, but I really want you, listen to me now, but please read these code sections on your own. Some are easy to understand than others. Sometimes you have to read something more than once. So B3A and B, 3 is substantial presence test. A says, in general, except as otherwise provided in this paragraph, individual meets a substantial presence test of this paragraph with respect to any calendar year, hereinafter in this subsection referred to as the current year, if I, such individual is present in the United States on at least 31 days during the calendar year. So again, you must be here, but this is me talking, not the code. If you're not in the United States for at least 31 days in a particular year, you are not a United States resident. And 2, the sum of the number of days on which such individual was present in the United States during the current year and the 2 preceding calendar years, when multiplied by the applicable multiplier determined on the following table, equals or exceeds 183 days. In the case of days, the applicable multiplier is for the current year 1. For the first preceding year, it's 1/3 or 1/3. For the second preceding year, it's 1/6, 1/6. Let's read B. So I'm in 7701 B3 cap B. Exception where individual is present in the United States during less than 1/2 of the current year and a closer connection to a foreign country is established. This is talking about the weak substantial presence test, at least as characterized by Professor Eisenberg. Individuals shall not be treated as meeting the substantial presence test of this paragraph with respect to any current year if I, such individual, is present in the United States on fewer than 183 days during the current year, and 2, it is established for the current year such individual has a tax home, which is a term defined in section 911 D3, and the code says without regard to the second sentence thereof, so you ignore the second sentence in 911 D3, in a foreign country and has a closer connection to such foreign country than the United States. We'll see the 2 key words here are going to be tax home, a defined term, and closer connection, a defined term. Under the weak form of the substantial presence test, days from the preceding 2 years are accorded less weight in arriving at the total than days of the calendar year. So, as I mentioned in reading the code section, specifically, days count 1 for 1 in the current year, but in the first preceding year, you count the days at 1/3. So if you were in the United States, suppose I'm going to have a real example coming up, but if you were in the United States in years 2019, 2020, and 2021, you would count the days in 2021 in full. You would multiply the days in 2020 by 1/3. You would multiply the days in 2019 by 1/6. I hope that's clear. Let me give you the example that I had in mind. And I'm going to say it more than once because you guys can't raise your hand and say, I didn't get it. A foreign national who's never been in the United States spends 90 days in the United States in 2017, 150 days in the United States in 2018, and 120 days in the United States in 2019. Let me repeat. This foreign national spends 90 days in the United States in 2017, 150 days in the United States in 2018, and 120 days in the United States in 2019. Let me pause for a second. In applying the substantial presence test, the individual will be treated as spending 180 days in the United States in 2018. Let's do that mathematically together. What we do is we look at the 2017 year, which is 1 year preceding 2018, and we multiply the 90 days spent in 2017 by 1/3. So 90 times 1/3, 1/3 is 30. For determining residence in 2018, we count the 150 days in full. So we add the 30 days counted for 2017 plus the 150 days counted for 2018. And in 2018, the person is not a US resident because he's only got 180 days and he needs 183 days or more. Let's now test residence in 2019. He's going to be a resident in 2019 because, as we'll see, you count 185 days for purposes of the weak substantial presence test in 2019. Let me add, there are some exceptions to weak substantial presence test, and I'm assuming in going through this, the exceptions do not apply. So let's work on the math together. In determining residence for 2019, we look at the second preceding year first, which is 2017. We multiply the 90 days in 2017 by 1/6. So 1/6 of 90 days is 15. So we count 15 for 2017. For 2018, we take the 150 days, we multiply that by 1/3, which is the first preceding year. So we add 15 for 2017 to 50 for 2018. That gives us 65. We add the 120 days in full in 2019. So we now have 185 days. And because we have equal or exceeded, in this case exceeded, the 183-day threshold, if no exceptions apply, then in fact, the individual is a US resident in 2019. I just want to point out that, under the weak substantial presence test, pursuant to 7701, little b in parenthetical, 3 in parenthetical, cap A in parenthetical, I in parenthetical, you still have to have 31 days in the current year. So even if mathematically, the 2 preceding years would give you such a number to be a resident in the current year, if you don't spend 31 days in the current year, you're not a resident. If one plays with the math, it follows that the greatest constant level number of days that can be spent in the United States year in and year out without creating residence 121. You multiply 121 times 1/3 plus 121 times 1/6. You're going to get, and you add to that 121 currently, you're going to get 181 and 1/3. So you're not going to hit the 183-day threshold. The upshot of the weak substantial presence test is an individual can spend fewer than 183 days in the United States in any given year and still be treated as a US resident. If there was no escape mechanism, someone who spends more time in another country in a given year or even permanently could still be deemed a US resident. If the time was spent in a foreign country having adopted the same test of residence in the United States, then you'd have a situation where the person would be resident in more than one country. And again, I'm putting aside tax treaty relief. The outcome of this is rendered less likely by a softening of the substantial presence test in its weak form. For individuals actually present fewer than 183 days in the United States during a calendar year, that is someone who looks to the weak substantial presence test rather than the strong one, Um, the only reason he would be a U.S. resident is by counting days in the prior 2 years. Then, as we'll see, he is not a U.S. resident if he has a tax home in a foreign country, and tax home is a defined term, and has a closer connection with that foreign country than to the United States. So in general, the weak substantial presence test, when you count days from the prior years, is inapplicable in situations where the foreign national has a tax home, which we'll go through and explain what that means, and a closer connection to a foreign country than the United States. Before we talk about the terms tax home and closer connection, I want to bring to your attention section 7701, little b in parenthetical, 3 in parenthetical, cap C in parenthetical. And let's read that section. 7701 B3C says, subparagraph B, not to apply in certain cases. Subparagraph B shall not apply to any individual with respect to any current year if at any time during such year such individual had an application for adjustment of status pending, or 2, such individual took other steps to apply for status as a lawful permanent resident of the United States. Thus, the exception to the weak substantial presence test does not extend to individuals who have applied for status to become lawful permanent residents of the United States or have pending an application for adjustment of their immigration status. For them, the 183-day period obtained by counting days only in the current for them, the 183-day period obtained by counting days not only in the current year but the prior 2 years, is inapplicable. I'm sorry, I misstated. It becomes applicable. Forgive me. If you've applied for a green card and you meet the 183-day test by counting not only the current year but the prior 2 years, that is the weak substantial presence test, you are a U.S. resident. The exception for tax home closer connection is irrelevant. I'm sorry for confusing you. I hope it's now clear. If it isn't, by all means, email me. Let's take a look at your book. I'm in 65 2.3, where Professor Loken describes a substantial presence test, including the weak version of it. Hold on let's stop for 1 second. And the substantial presence test, I'm just reading from Professor Loken's book, an alien individual who is present in the United States for at least 183 days during a taxable year is a resident for tax purposes. An alien present in the country for fewer than 183 days during the current year is a resident if he or she is present for at least 31 days during the current year, spends substantial portions of her time in the country during the 3-year period ending with this taxable year, and has a closer connection to the United States than to any foreign country. Exceptions are provided, however, for teachers, students, commuters from Canada and Mexico, and a few others. These rules are described in more detail later in this section. And again, Professor Loken's paragraph's a bit of a generalization that we will flesh out. Normally, the substantial presence test is met for a particular calendar year if the taxpayer is present in the United States on at least 31 days during the year and meets an 183-day test. I'm reading from Professor Loken. 65.2.3. The 183-day test is satisfied only if the sum of the days present in the United States during the taxable year, 1/3 of the days present during the immediately preceding calendar year, and 1/6 of the days present during the second preceding year is at least 183. The 183-day test is met, for example, if a taxpayer has been present for 122 days or more during each of these calendar years, 122 plus 1/3 of 122 plus 1/6 of 122 equals 183. An alien individual, I'm going on reading Professor Loken, who meets both the 31-day test and 183-day test, is nevertheless a non-resident if she, one, is present in the United States for fewer than 183 days during the calendar year, two, has a tax home in a foreign country during the year, and three, has a closer connection to that country than to the United States. An individual has a tax home at a particular place if she would be allowed a deduction under Code Section 162A2 for expenses incurred in traveling away from a place, from that place on business. According to the regulations, this means that an individual's tax home is at her regular place of business if she has more than one regular place at the principal place of business. So let me stop for a second and repeat this. And I'm going to repeat it some more later. But tax home generally means one's principal place of business, yes, or principal place of employment. Let me go on with your book. An individual, and again, I'm still in 65.2.3. Individual has the closest connection with the country with which she has maintained more significant contacts, including the location of a permanent home, family, personal belongings, personal bank accounts, the location of the social, political, cultural, and religious organizations with which the individual has a current relationship, where she obtained her driver's license, where she votes, and the country of residence designated on documents filed by the individual. However, closer connection exception is not available if the individual has applied to become a permanent resident, and this application is pending at any time during the taxable year. This is section 7701, little b in parenthetical, 3 in parenthetical, cap C in parenthetical, which we just covered. All right, so let's discuss, I'm leaving Loken now. Let's just discuss tax homes some more. As we said, we will come back to tax home later on in connection with section 911, which is going to be our third module, which deals with an exception for housing and foreign earned income from being included in gross income, from being taxed in the United States. As I said, tax home generally means one's principal place of business or employment. And this, you know this from, well, the starting point is taking a look at 7701 B in little b in parenthetical, 3 in parenthetical, cap B in parenthetical, which uses the term tax home. It says basically, as defined in section 911, little d in parenthetical, 3 in parenthetical, and it goes on to say, without regard to the second sentence thereof. So let's read 911, little d in parenthetical, 3 in parenthetical, but skip the second sentence as instructed by 7701 B3B. The term tax home means, with respect to any individual, such individual's home for purposes of section 162, little a in parenthetical, 2 in parenthetical, which relates to travel expenses while away from home. Despite the unmistakably residential ring of the term home, the IRS has persistently asserted, for purposes of 162, the tax home refers to the individual's principal place of business or employment rather than where the individual lives. This position is included in the regulations. It's Reg Section 301.7701, little b in parenthetical, dash 2 in parenthetical, C in parenthetical, 1 in parenthetical. Again, as I noted earlier, I'm not going to test you on regulations. I'm giving you the sites, for self-study or for use at work. Most of the case law supports the position in the regulations. As Professor Loken points out in paragraph 65.2.3 footnote 19, only if the individual has no place of business or employment, then the tax home is at the individual regular place of abode in a real and substantial sense. We'll discuss abode when we get to section 911, but think of it as having residential rather than business ties. So bottom line, there is strong authority. There is some contrary case law, but most of the authority is that a tax home means one's principal place of employment or business, and only if one is not in business, does not work, do we look to residential ties with respect to the definition of tax home. Again, if you have any questions, feel free to email me. You pause for a second. So we don't lose the big picture here. We're talking about an exception to the weak substantial presence test in 7701, little b in parenthetical, 3 in parenthetical, cap b in parenthetical, that generally someone who's not been in the United States for 183 days in the current year without counting prior year days, that is, in situations where you're under the weak substantial presence test, you are counting not only current year days, but days in the first and or second preceding year. You are generally not subject to having residence on the weak substantial presence test if you have a tax home and a closer connection to a foreign country than to the United States. So a tax home in a foreign country and a closer connection to a foreign country than to the United States. This exception does not apply if you have 183 days of count, all days count of residence. So if you're under the strong substantial presence test, this exception doesn't apply. This exception doesn't apply also, again, if you applied for a green card at 7701 B3C that we mentioned earlier. It's frankly difficult for me to talk straight for this long period of time, so I need to stop every once in a while, and I'm doing that currently. As Professor Eisenberg observed, for individuals present in the United States fewer than 183 days in the current year, substantial presence created by individual days from prior years creates in effect a presumption of United States residence, which can be turned back by someone whose personal epicenter is demonstrably in another country. One would expect, for example, an individual spends 150 days in the United States, but also spends 215 days in another country and maintains a principal residence and essential social connections to that country, and also has economic connections, that is a tax home there, could make the necessary showing to avoid United States residency. Again, this assumes the person has not applied is not within 7701 B3C, for example, applied for green card status. In contrast, Professor Eisenberg notes individuals who distribute the remaining 215 days of the year between several countries would in all likelihood be treated as a U.S. resident under this test. As we discussed earlier, an individual has the closest connection with the country with which she has maintained more significant contacts, including the location of a permanent home, family, personal belongings, personal bank accounts, the location of the social, political, cultural, and religious organizations with which the individual has a current relationship, where she obtained her driver's license, and where she votes, and the country of residence designated on documents filed by the individual. And again, this is covered in 65 2.3, third paragraph. As Professor Eisenberg pointed out, that because the closer connection test can be more subjective than the tax home test, it is even more at variance with what Congress had in mind when they enacted these provisions in 1984 to make the determination of resident alien status as objective as possible. So while that was their intention, there are certainly gaps as to what actually has occurred. Again, I need to stop for a second. One commentator pointed out that in practice, the section 7701 B, little b in parenthetical, 3 in parenthetical, cap B in parenthetical exception, the weak substantial presence test provides protection from resident alien status, principally for aliens who are residents in countries that do not have an income tax treaty with the United States. Those from treaty countries would usually be protected from U.S. resident status without the need for this exception, because the tiebreaker rules in treaties would often result in their being classified as treaty country residents and thus non-residents for U.S. tax purposes. These tiebreaker rules are discussed in your paragraph 65.2.8, which I'll cover at the end of the module. Both the strong and weak substantial presence test refer to days in the United States. 7701 B3B talks about days in the United States. So the next question comes up is, what do we mean by United States? And what do we mean by the term days? Pursuant to section 7701, little b in parenthetical, 7 in parenthetical, cap A in parenthetical, for purposes of the 183-day test, a resident is any day in which an individual is physically present in the United States at any time during such day. So you can be here for a second, and that counts as a day for counting for substantial residence purposes. As to what the term United States means, according to section 7701, little a in parenthetical, 9 in parenthetical of the Internal Revenue Code, it includes the 50 states in the United States and the District of Columbia. It doesn't include territories, possessions, and commonwealths. So Puerto Rico, Guam, U.S. Virgin Islands are not considered the United States for purposes of this provision. I hope that's clear. Again, if you have any questions, feel free to email me. The regulations, including the definition of the United States, the territorial waters of the United States, and the seabed and subsoil of those submarine areas in accordance with international law. And the reg section that I'm referring to is section 301.7701, little b in parenthetical, -1, little c in parenthetical, 2 in parenthetical, 2 lies in parenthetical. So say someone working on a oil drilling platform in U.S. territorial waters could become a U.S. resident because those waters are considered to be the United States. In terms of counting days, because 7701B, little b in parenthetical, 7 in parenthetical, cap A in parenthetical, says you count a day for this purpose if in the United States at any time. If one is in the U.S. from, say, 11:59 p.m. to 12:01 a.m. the next day, then that counts as 2 full days. So, 2 minutes can count as 2 full days. Professor Loken writes in your text in paragraph 65.2.3, fourth paragraph, in applying the substantial presence test, individual is considered present in the United States for a particular day if she is physically present in the United States at any time during such day. For example, if individual arrives in the United States one evening and leaves the country early the next day, she is present in the United States for 2 days. There are some exceptions as to what constitutes a day in the United States for substantial presence test purposes. And we're going to be talking, for a while now, when you don't count a particular day. One exception is for commuters from Canada or Mexico, which is contained in section 7701B7. I want to correct something in my notes. Hold on for 1 second. Okay, this is covered in your text in 65.2.3.1. Let's read Loken's write-up in 65.2.3.1, titled Commuters from Canada and Mexico. Individual who regularly commutes to work in the United States from a place of residence in Canada or Mexico is deemed not present in the United States on any day during which he so commutes. Individual's work may be either as an employee or self-employed person. The regulations can construe commutes to require that the person return home at least once during each 24-hour period. This is why this would be highly unusual for somebody who is, say, living in New York City. This would apply to, towns near the Canadian or Mexican borders. An individual, for example, travels to the United States once each week, staying for 2 or more days on each trip, is not protected by this rule. Also, and again, I'm going through the Loken text now. Also, the person must commute to the United States, place of employment, or self-employment on more than 75% of the work days during the working period. The working period begins with the first day during the calendar year when the individual is physically present in the United States for employment or self-employment, and ends with the last day during the calendar year when the individual is so present. It is therefore possible for seasonal and cyclical employees, as well as those who begin employment in the United States in mid-year, to exclude the days of presence on which they commute to the United States. However, a seasonal employee, again, I'm reading from Loken text, who commutes daily to the United States from, say, September through April each year and works in Canada or Mexico for the remainder of the year, is out of luck because the working period for each calendar year begins in January and ends in December, and the May through August hiatus includes more than 25% of the working days of the year. Another exception for counting days, the substantial presence test, is transit between 2 foreign points exception. That's contained in section 7701, little b in parenthetical, 7 in parenthetical, cap C in parenthetical. This is sometimes referred to as the short stopover or passing through exception. Let's read Loken's write-up in 65.2.3.2. And it's titled Short Stopovers. Presence while in transit between 2 points outside the United States is ignored if the person in the United States for less than 24 hours. For example, a Canadian who passes through an airport in the United States, say Miami Airport, I'm adding, en route to South America, is deemed not present in the United States at all for purposes of the substantial presence test. This exemption is lost, however, if the individual conducts business while on a stopover in the United States, even a meeting in an airport. So again, suppose that the best way of getting from Toronto to Rio de Janeiro is to fly from Toronto to Miami and connect planes going to Rio de Janeiro in Brazil. If you don't conduct business in the Miami airport, don't call the client, say, then, the time at the airport would not count. That rule is usually important only to a person who is also president of the United States for other reasons during the year. That was the only day. One day would not, would not be a problem. But suppose that you were here in the United States for 182 other days for pleasure trips, and now you have a stopover in the Miami airport, and you foolishly call a client, from the Miami airport. Voila, you've hit the 183 day mark. But if you don't call a client and you've only been here 182, and without regard to the look back, the weak substantial presence test, you wouldn't be a resident. So Loken goes on to say it's unlikely that an individual would pass through the United States in transit often enough to be caught by the substantial presence test, even in the absence of the rule. However, a person who becomes or ceases to be a resident by reason of a more sustained stay in the country, this rule can play an important role in determining when residence begins or ends. For example, if an alien leaves the United States in July, concludes a lengthy period of domicile in the country, but passes through the country in transit during November of the same year, the person may rely on this rule to establish that residence ends in July, not November. Another exception to when days count toward meeting the substantial presence test is contained in section 7701, little b in parenthetical, 7 in parenthetical, and d in parenthetical, and provides that for purposes of counting days, the substantial presence test, an individual who is temporarily present in the United States on any day as a regular member of a crew of a foreign vessel engaged in transportation between the United States and a foreign country or possession of the United States shall not be treated as present in the United States on any such day unless such individual otherwise engages in any trade or business in the United States on such day. Loken covers this in paragraph 65.2.3 and writes, a non-resident alien is deemed not present in the United States on any day when the person is temporarily present in the United States as a regular member of a crew of a foreign vessel engaged in transportation from the United States and a foreign country or U.S. possession, unless the person otherwise engages in any trade or business in the United States on such day. Let's talk about another exception for counting days, and this is the medical emergency exception. And it's contained in 7701, little b in parenthetical, 3 in parenthetical, cap D in parenthetical. That section is titled Exception for Exempt Individuals or for Certain Medical Conditions, and provides that an individual shall not be treated as being present in the United States on any day if I, such individual, is an exempt individual for such day, or to realize such individual was unable to leave the United States on such day because of a medical condition which arose while such individual was present in the United States. Excuse me, I'm sorry. It's difficult for me to talk, continuously for a long time. As your text notes in paragraph 65.2.3.3 for a sentence, a day of presence in the United States is disregarded if the taxpayer is unable to leave the United States on such day because of the medical condition which arose while such individual is present in the United States. The exception applies only if, in quote, the individual intends to leave and is unable to leave the United States because of a medical condition that arose while the individual is present in the United States. Loken goes on to write, it does not apply if the condition or problem existed prior to the individual's arrival in the United States, and the individual is aware of the condition or problem, regardless of whether the individual required treatment for the conditions or problem when the individual entered the United States. One author provides the following somewhat humorous hypothetical, depending on your taste in humor, you may not find it very humorous. But the hypothetical is as follows. A tourist who lapses into coma upon being presented, with a bill from the 21 Club. The 21 Club used to be an exceptionally expensive restaurant in New York City that I never frequented, which was so he lapses into coma when he sees the bill, spends the next 9 months in a New York hospital attached to a life support apparatus. He doesn't suffer the additional blow of becoming a tax resident of the United States, right? Because he incurred a medical emergency that arose when he was in the United States. As noted, this exception does not apply if the foreign national knew about the condition prior to coming to the US. So I'm not sure if you guys are aware of it, but the Cleveland Clinic in Cleveland, Ohio, is supposed to be world-renowned for cardiology. And suppose a foreign national flies to the Cleveland Clinic for heart surgery and spends the next 7 months recuperating in Cleveland. The days would count because the medical emergency exception would not apply because he was aware of the condition before he came to the United States. I think that if a person came to the United States and became aware that he or she had cancer in the United States, had no knowledge of it, when he would before he came to the United States, then that would come within the medical emergency exception. And so days spent in the United States treating that medical emergency, would not count for the 183-day purpose. Furthermore, the medical exception does not cancel residence already established in a given year by a foreign national. So let's suppose a foreign national spends 200 days, in the United States, and has a medical emergency on day 201. This doesn't help him. He's already, he's already hit the 183-day threshold, so he's a U.S. resident. Let's read the last 2 sentences in paragraph 65.2.3.3 in your text. Congress expected that few individuals would be physically unable to leave the United States. The exemption might apply, for example, to a person who is in a serious medical accident shortly before a planned departure date. Also, even if the individual initially qualifies for the exemption, the substantial presence clock starts running if on becoming well enough to travel, the individual remains in the United States beyond a reasonable period for making arrangements to leave the United States. Let's take a 2-minute stretch break. So I'm going to just shut down my video.